You ever look at a real estate sale and think, how bad could the tax outcome really get? In this case, it started with roughly $0 of gain reported. Then once the IRS came knocking, the story shifted to a position that, when rounded, put the taxable gain at about $56,000. This all played out over a stretch of years, the opinion pins down with specific purchase and sale dates. The swing from nothing to report to, okay, fine, some gain, was on the order of $56,000, and then tax court landed at roughly $255,000 of taxable gain anyway, which is about $200,000 more than the taxpayer was trying to live with. The theme the court ultimately stamped on it was blunt. This was the case where records were thin and the consequences landed where the court said it must bear heavily upon the taxpayer. My name is Alex Dvorkin. I'm a certified public accountant in the state of California, and if you like this kind of real-world tax storytelling, please like this video and subscribe to this channel. In this video, we cover tax court decision in the case of Jeffrey Pesarik versus Commissioner of Internal Revenue, decided on February 23, 2026. The opinion opens with a simple setup that turns into a problem. During 2020, the taxpayer sold two properties, one in Wakefield, New Hampshire, and the other in Hull, Massachusetts. The Wakefield property sold for around $187,000, and the Hull property sold for around $557,000. And then comes the line that basically lights the fuse. He didn't report the gain from either sale on his 2020 federal income tax return. The IRS responded the way the IRS responds when it sees property sales on third-party reporting and doesn't see matching tax reporting. It issued what the court describes as a computer-generated notice of deficiency, calculating a deficiency of roughly $272,000 and an accuracy-related penalty of about $54,000, calculating automatically via electronic means. Now, if you're hearing computer-generated and thinking, so the IRS just plugged in numbers, that's basically the vibe here. But the taxpayer didn't come in empty-handed. He came in with a story. The Wakefield property, he said, had serious renovation costs that raised his basis and shrank the taxable gain. And the Hull property, he said, was his principal residence, long enough that the whole gain should be excluded under Section 121, the home sale exclusion. To understand why that argument mattered, you have to meet the taxpayer where the court met him, in his background. The court explains he grew up in New Hampshire, earned a bachelor's degree in business management and finance, and worked as a property manager in multiple cities, Seattle, Dallas, Washington, D.C., so this is not someone wandering accidentally into real estate. The opinion paints someone comfortable in that world. Then life bends the plot. He moved back to New Hampshire in fall 2016 to arrange the affairs of his late mother. He used his property experience to renovate and sell her home, and the court even recounts his estimate that his work bumped the value from about $400,000 to about $587,000, and that each sibling received about $157,000 from the sale, with the taxpayer reimbursed for expenses. The context matters because it helps explain why the court later side-eyes him on "I thought I sold at a loss" argument. When you've been doing property management and renovation, the court is going to listen, but it's also going to expect you to have a grasp on what you're doing. Then comes property number one, the Wakefield property. The taxpayer bought it on November 17, 2016 for about $30,000. The court repeats his characterization of what he bought. Basically a chicken coop and a torn up and hammered house in an extremely rural community. He said this wasn't minor work. He pretty much built a new house, including underground utilities, water, septic, and foundation work. Property number two is the Hull property. He bought it July 6, 2018 for around $395,000. The court notes it's 2 blocks away from the beach and about 2-hour drive from Portsmouth, New Hampshire, on the far side of Boston. The court also flags facts that later become important. He didn't file Massachusetts state income tax return while he owned it, and he didn't get a Massachusetts driver license. In 2020, the properties sell one after another. Wakefield goes first, sold for about $187,000 on March 30th, 2020, and he incurred around $18,000 in closing costs. Hull sells later, October 7, 2020, for about $557,000 with roughly $25,000 in closing costs. And there is one detail that almost cinematic. Shortly before the Hull property sale closed, he provided an Arizona driver license to verify his identity as the owner. So what was going on financially in the background while all this was happening? The opinion spends time on it because the taxpayer's proof depended heavily on statements. The court explains that during these years, he relied on credit card and business bank accounts under the name of a sole proprietorship called Internet Realty. A Home Depot credit card becomes a big character in the story. He spent around $46,000 on it over time, and there was also a Lowe's card with roughly $8,000 in spending shown. The statements show his address shifting. Early on, there is a Virginia address on American Express statement, then his late mother's Portsmouth address, then Portsmouth post office box, and then starting around early 2020, addresses switched to either the Hull property or a Hull post office box. Then address drift becomes a key narrative clue when the court later asks, was Hull really his principal residence starting in 2018 like he claimed, or did he only really move there in 2020? Then we get to the tax return. On the 2020 federal return, he used the Portsmouth post office box as his home address. He reported taxable income of around $16,000 and claimed what the court describes as a refund of $60. That is basically nothing. And crucially, he didn't report income from either property sale. That launches the legal fight into two big questions. How much gain was there on each side, and could he exclude the Hull gain under the home sale rules? The court starts with the basics. Gain is the amount realized minus adjusted basis, and the basis starts with the cost but can be increased by capital expenditures. And then the records keeping rule hovers over everything. Taxpayers have to keep records, and if the records are inadequate, the court may estimate, but only if there is some basis upon which the estimate may be made. The estimation doctrine is where Wakefield storyline becomes the main event. The Wakefield, the taxpayer tried to frame it like this. Sale price around $187,000 minus a claimed purchase price of about $31,000 minus claimed improvements of about $82,000 minus closing costs of about $18,000, getting him down to a gain of nearly $56,000. But the court immediately trims the story back to what the documents actually support. The deed said he acquired Wakefield for $30,000 in consideration paid, and the court says he didn't provide persuasive evidence for the higher purchase price. On closing cost, the statement supported about $18,000, and the court treated those as capital expenses to sell the property. Now we get to the hard part, improvements. The IRS considered he spent money improving Wakefield, but argued the evidence didn't support the exact amount and shouldn't even allow the estimate. The taxpayer leaned on monthly bank and credit card statements plus his testimony to say, look at all these Home Depot and Lowe's charges. Look at these checks. That's my renovation money. The court explains why that proof method struggled. Except for a few checks with the street number, none of the transaction entries directly tied to Wakefield. And that mattered because he owned other properties, renovated his mother's home, and testified he put money into Hull too. The court describes the allocation problem. It becomes difficult to allocate certain expenditures to the Wakefield property with much certainty. It gets worse. Many credit card entries were broad categories like paint, hardware, lumber, and seasonal garden, which the court calls vague. Those categories don't tell you what was purchased or whether it was a capital improvement rather than personal spending or maintenance. The court gives the taxpayer some credit as a witness, literally saying it found him credible in broad strokes, that he spent money to renovate the property. It also found credible and specific testimony about certain checks to electricians and painters. But for the bulk of the spending, the credit cards, the court says his testimony was too vague and non-specific. He tried to spreadsheet allocation charges between Wakefield and Hull, but the spreadsheet created its own set of headaches. The court notes he didn't explain the allocation method, the entries conflicted with the statements, and it even allocated spending on a property before it was purchased or after it was sold. Plus, it didn't reconcile purchases and returns. Still, Wakefield didn't end in total wipeout. The court says the statements informed by testimony gave an adequate foundation for an estimate, and then it builds the estimate in two stages. First, it allowed about $6,000 in checks, either marked with the property street number or paid to a painting company he credibly discussed. Second, the credit cards. It only looked at identified Home Depot and Lowe's spendings, and then this is the part that tells you how cautious the court was. It gave him only 1/4 of the total. The court explains why. It had little confidence that other charges were capital improvements rather than personal expenses, and it invoked that classic warning, it must bear heavily upon the taxpayer. It also pointed to his own testimony that he owned 4 properties and improved them, and he failed to keep separate records. The math the court accepted was about $59,000 of Home Depot and Lowe's spending during the ownership period. 1/4 of that is about $15,000, plus about $6,000 of checks. Total capital improvements around $21,000. And that's how the Wakefield gain lands. Using the roughly $187,000 sale price, minus about $30,000 cost, minus around $18,000 closing costs, minus around $21,000 estimated improvement, the court found gain to be around $118,000. Hull is faster, almost like the court is saying, you are not doing this all over again. The purchase price and closing costs were stipulated about $395,000 cost and around $25,000 in closing cost. The taxpayer didn't even argue capital improvements for Hull, so the court treated it as considered. That yields gain around $137,000. So now we have the key fork in the road. Does Section 121 wipe out the Hull gain? Section 121, as the court describes it, can exclude up to $250,000 of gain for an individual if the taxpayer owned and used the property as principal residence for at least 2 years of the 5 years before sale. The court defines principal residence as the chief of primary place where a person lives, and it notes the fact and circumstances test, including things like addresses on returns, licenses, mailing addresses, banking, and so on. The taxpayer's problem is timing. Hull was bought in July 2018 and sold in October 2020. So to get 2 years, it basically had to be his primary residence essentially from the start. But the record didn't support that. The court stresses the problems with support. He owned at least 2 other properties when he bought Hull. He didn't introduce evidence consistent with moving. No moving company, no cargo van, no furniture purchases, and didn't explain why not. He also didn't provide solid information about how much time he actually spent at each place, beyond vague testimony. Then the court stacks up the factors he did have, and they cut against him. He had an Arizona driver license. He didn't file Massachusetts income tax return for years 2018, 19, and 2020. He used the Portsmouth address on his 2020 federal return, and the billing address matters. Statements went to Portsmouth Post Office Box from July 18 through January 2020, and only then did some start going to Hull for Hull Post Office Box. The court makes an observation that reads like a narrative interference grounded in the record. He updated his mailing address quickly when he moved back to New Hampshire, which suggests he didn't consider himself moved to Hull until 2020. He tried using credit card transaction locations to prove he lived in Massachusetts, but the court says the purchases weren't consistently in one place and were wholly inconclusive, calling them an unreliable measure of whether Hull was primary, second home, or a beach house. He also brought a summary record of electric bills. The court points out it didn't even name the utility, raising questions about his provenance. And even if it were real, fluctuating electricity usage doesn't prove principal residence. The court notes electricity can stay on with low baseline usage, and higher usage might just mean he was there sometimes. Finally, he claimed legal difficulties kept him in Massachusetts for months, but he didn't produce supporting evidence like court filings, nor did he provide specific periods to define residence. So the court's bottom line is clear. He didn't carry his burden, and he is not entitled to exclude the gain under Section 121. At this point, the numbers snap into place. The court found he failed to include about $255,000 of income from the two 2020 property sales that tease up the penalty. The penalty at issue is the 20% accuracy related penalty for a substantial understatement. The court says the IRS met its burden of production and it addresses the reasonable cause defense. The taxpayer first tried. I thought Wakefield sold at a loss. The court responds with what is basically disbelief grounded in the math and taxpayer's background. There was no evidence he tried to assess his proper liability, and thinking you took a loss when you were paid more than 6 times your purchase price was objectively unreasonable. And the court says that conclusion is bolstered by his education and long experience with real property. He also raised disabilities, post-traumatic stress disorder, depression, and attention deficit disorder. But the court says he failed to show the disabilities interfered with his ability to report properly or caused the understatement. So the penalty sticks. The decision will be entered under Rule 155. And that's the story. A taxpayer sells 2 properties in 2020, reports none of the gain, tries to reconstruct bases with broad statements and a spreadsheet, gets some relief through estimates on one property, but can't prove the beach area place was the principal residence long enough to make the gain disappear. The court gives a little where it has a foundation, and then it does exactly what it warned it would do. It bears heavily when the taxpayer's records keeping leaves the court guessing. My name is Alex Dvorkin. I'm a certified public accountant in the state of California. If you like this video, please give us a thumbs up and subscribe to this channel. And I'll see you in the next tax court case review.